Hello and welcome to Portfolio Matters, week 71, and it's been another volatile week in the stock market. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith, what have we got this week?
Thank you, Richard. Well, first of all, can we thank a few of our Discord members for their donations? We had to subscribe to Zoom this week and put out a plea for some donations to pay for that. And Tom, Simon and Umar, particularly Simon, answered the call and have paid for our Zoom subscription. We really appreciate that. Thank you very much. A reminder, we very gladly accept donations, and you can see our GoFundMe page at the bottom here. Okay, news this week. Well, having rallied, US equities then collapsed on Wednesday afternoon after the US retailer Target missed earnings expectations and warned of margin compression. Now, regular viewers of the Weekly will know that we have been warning about very high producer price inflation and lower consumer marginal spending, and the result is we expect consumer-facing industries to have their profits squeezed, and the market is beginning to appreciate that, and the numbers are starting to come through. Sunac has become the latest Chinese property developer to default. It's number 4 in China, 4th largest. The Bank of England warned of apocalyptic rises in food prices, and India banned the export of wheat. So as food prices rise, so exporter countries are engaging in resource nationalism in order to keep the prices down. And that, of course, exacerbates price rises for everyone else. And finally, hopefully some good news. Shanghai has allowed a few retailers to reopen. Let's hope that China starts to reopen fully. Okay, so this is the share price of Target, and you'll see that it fell sharply, taking the rest of the market with it, and then falls on Wall Street, spread to the rest of the world on Thursday. And this is the Nasdaq over the last week, and essentially it can't sustain any rallies. And Sunac is China's 4th largest property developer, and it defaulted on payments on a 742 million offshore bond. It has debts of around 11 billion in total. And as you can see, the market has been expecting problems at Sunac for a while now, but it's finally started to default. And this is the price of wheat, which leapt following India's decision to ban exports. And if you're interested, I have included the commentary from Trading Economics in the window here. Essentially, the world is also having a bad crop. So the stars are aligning, I'm afraid, for a real spike in wheat prices. Okay, and on to this week's economic data. So we had some sadly bad figures from the US Michigan surveys of consumer sentiment. The May number for the Consumer Sentiment Index was expected at 63.5, and it came in at 59.1, well down on April. And the Current Conditions Index came in well below expectations as well. So it paints a picture of consumers who are worried about the present and the future. But at the same time, US retail sales for April came in above expectations. So although US retailers are depressed about the current and future, they're continuing to spend. And the and moving to the UK unemployment rate fell to the lowest it's been in many, many years, beating expectations, falling to 3.7%. And the tight labour market meant that UK earnings growth, including bonuses, grew to 7% per annum in March, and that substantially beat expectations. Expectations were for 5.4%. So that is the beginning of a wage price spiral. And we had UK inflation numbers, and they were disappointing. So came in very hot. So UK CPI in March was at 7%. The April number was 9%. A huge leap, and just beat expectations of 8.9%. Core CPI also beat expectations and came at 6.2%. RPI, which is the way we used to measure inflation, came in at an enormous 11.1% in April. Some charts, Richard. Oh, sorry. And we had one quarterly number, which was quite reassuring, actually. So European GDP growth quarter on quarter annualized for Q1 came in at 5.1%, ahead of expectations despite the impact of the war in Ukraine. Some charts, Richard.
Thank you, Keith. So Empire Manufacturing Survey, below zero, where it spends quite a lot of its time historically. So we need to wait to see what happens. And the US Michigan Consumer Sentiment Index is on a fairly consistent downward trend now, but not yet at the 2010 lows, not far off. And the Current Conditions Index is heading towards its 2010 lows as well, all painting a picture of a slowdown in the US economy. Well,
consumers are as depressed as they were during the great financial crisis.
And they're not really expecting it to get much better either at the moment. Inflation expectations a level at 5.4%. They're remarkably stable, I would say, given what's going on.
Yeah.
And US sales growth, actually, it looks low, but 8.2%. You know, that's fairly chunky. Obviously, you have to. Yeah.
Well, what I'd say about US retail sales, Richard, is that 8.2%. After adjusting for inflation, that's negative.
Yeah. So is this real or is it absolute?
No, this is absolute.
It's absolute. In which case, yes, it is. It is not. It shows an economy that is slowing down. UK CPI is continuing to elevate rapidly, depressingly. Anecdotally, we had our Sainsbury's order arrive yesterday, £94. And as I was unpacking it, I was thinking, a year ago, this would have been £65. Extraordinary. But that, of course, would be an inflation rate of about 80%.
Well,
60 to 50%.
Well, food price inflation will be very strong and will get stronger, I think.
It will be. So UK RPI going the same way. I mean, there is a school of thought that says, despite all the breast beating by politicians and central bank governors, they don't care about inflation. In fact, they're rather pleased to have it because debt to GDP will be dropping rapidly. There's also the question which comes to my mind about if you're not measuring the inflation rate properly, you can't trust your GDP growth figures, and we may well be in a recession. But let's move on to that later. So UK unemployment rate very, very low, and clearly Brexit has had an impact on that.
Yeah, so UK unemployment rate is the lowest it's been since the late 70s. Yeah. Extraordinary.
Yeah. And claimant count change. Well, you'd expect the claimant counts to drop, given that the unemployment rate is dropping. And average weekly earnings, it's a bit bouncy, but it's as high as it's been since 2007.
Yeah, but this, of course, masks big sectorial differences. The public sector, in particular, their wage growth, I believe, it's below 2%.
Yeah.
So public sector workers are seeing their incomes really squeezed,
and that will pop at some point.
Precisely. And when you were talking earlier about how the government secretly likes inflation because it eats away at the debt, well, you can do that only to a certain extent before public sector workers really start to protest, and you get a lot of unrest.
Yeah. So we didn't put in a chart of the EU GDP growth, which in the table that Keith went through was about 5% growth. But my view is that inflation everywhere is still understated. And if you actually deflate the absolute GDP by the correct inflation figures, you may well find that Europe is either not growing very slowly, or even in negative real GDP growth. And that, of course, would be heading rapidly towards a recession. So I'm rather dubious about all the inflation numbers, particularly given my own experience, which I've just described. But we can summarize all of this by saying that the US consumer sentiment continues to deteriorate and is at low levels, and US consumer spending is basically being backed up by credit, and that can only persist for so long. And inflation control in the UK is going to be difficult because the unemployment rate is so low, and that fuels wage inflation. And we believe that UK inflation has yet to peak. We don't know where it will peak, but there is possibly the beginning of that wage price spiral that Keith referred to. And in theory, the Bank of England will have to continue to raise rates as inflation is high and interest rates are very low. Whether it can actually do so without crashing the stock market, and particularly, I think, in the UK, the property market, remains to be seen. And I think, the central banks are in this horrendous dilemma. And I think there's a lot of chest beating. And I think that they don't particularly mind having this high inflation rate.
Well, I think they're going to have to raise rates, Richard, until they crash the economy. And reiterate what we've been saying for many weeks now. We are expecting a recession later in the year. In fact, I think the economies of the world are rolling over already. But put it in perspective, the Bank of England has an inflation target of 2%, and we're currently at 9%. Monetary policy is inappropriate.
Well, we're slightly in an Alice in Wonderland world, I think, Keith, because we have huge financial condition tightening through exogenous price increases that are nothing to do with what's going on in the UK, basically commodities and supply shortages. And the Bank of England is raising its interest rates by 0.5% now and then in order to try and reduce the rate of inflation. I mean, the whole thing is bizarre, frankly. It's bizarre. So I don't think they know what they're doing, really. I don't think they've got a solution. I personally don't think they will raise interest rates that much because they will not want to crash the economy. They will not want to crash the property market.
Okay, well, watch this space. I think they've got no choice. Okay, on to inflation watch. And we had UK numbers this week, and they all came in very hot. So CPI 9%, up 2%. So the March number was 7%, core CPI up, RPI also up. Interest rates in the UK are 1%. So real interest rates are -8% in the UK. Now, this is a breakdown of April inflation in the US, and you'll see that fuel oil, so that's diesel and gasoline inflation, were really high. So US consumers are having to pay much more at the pump, and that is inherently deflationary. They're going to have to spend more on fuel and less on other things. But the other piece of data I wanted to highlight was shelter. Now, we have talked about this many times on the weekly, but rent is a huge component of the US consumption basket, and they measure rental price inflation by a survey rather than using market data. And we know the rental inflation has been really strong, but they are massively understating that, and that should start to come through. In fact, it should be already coming through. And if the CPI numbers start to reflect reality, then CPI should persistently be higher than expectations going forward. These are US gasoline prices, and in nominal terms, they are at an all-time high. And reminder, one of the cycles I play is the oil cycle, and whenever the oil price gets very high, it kills the world economy. And the price at the pump will be now starting to affect US consumers' discretionary spending. Now, this is US goods inflation, and you'll see that service inflation is really starting to pick up. So a lot of the inflation we've already seen was due to supply chain difficulties and the fact that during COVID, everyone wanted to spend on goods rather than services. But now the high inflation is starting to broaden and leak into services. And that means it will be persistent. And the Fed will have to continue raising rates to get inflation under control. And this is wheat. And if you look at the lower chart, you'll see stocks are falling. So essentially, you need to get the wheat price up until you have balance between supply and demand, and that may be a lot higher.
I also think here, Keith, that the issue is that the projected supply over the course of the next 6 months is significantly reduced in terms of what it needs to be, and so we will expect to see global stocks fall quite rapidly under those circumstances, and the prices are anticipating that event.
Yeah. And a reminder that economists, we love these charts, economists are totally useless at forecasting inflation. They're always expecting it to subside, and they keep on getting it wrong.
I would say, without wishing to offend any of our listeners, they could do with a dose of Viagra, I think, couldn't they, Keith?
This chart should, yes. And now we talked earlier about US retail volumes and how if you deflated by inflation, that 8% year-on-year growth would be negative. And this is that chart again. So if you look at nominal retail sales, they're running hot. If you look at inflation adjusted, they've come right down. So in summary, household budgets are being squeezed by rising food and fuel prices. The US rental CPI appears unrealistically low, and Richard talks about how CPI is manipulated. Well, frankly, on this particular issue, I agree with him. The US rental CPI is just wrong, and that's understating US inflation. So, bottom line, if the Fed wants to get inflation under control, it's going to have to keep on raising rates, and that is bad for markets and bad for the economy.
I'm just going to prognosticate here for a moment, Keith, to say the Fed will stop its interest rate rises quite soon for the same reason. They cannot crash the market, and they are indifferent to inflation in terms of the effect on ordinary people. Biden isn't because of his electoral chances, but the main impetus of the Fed is to maintain the strength of the dollar and doesn't really care about anything else.
Well, I disagree, Richard. I think obviously the Fed is a political entity, and it will come under pressure to stop its interest rate rises. But I think Biden needs to get inflation under control, and I think the Fed will have to keep on rising. I think the next two Fed meetings, you'll see 0.5% rises. And then even at the end of that, interest rates will be very strongly negative.
It will be. And I think a lot of what they're actually doing, the talk, is to frighten the markets into thinking there will be interest rate rises to try and avoid them having to make them.
Well, they're certainly crashing the market at the moment. They don't seem to have, and there doesn't seem to be any intimation they're going to change course. So I expect the next two rate rises to be absolutely baked in, and we'll see what happens thereafter.
Yeah.
Okay, on to Invasion Watch. Richard.
Thank you, Keith. So we have last week and this week. Very little difference. So Ukraine actually is starting to regain some territory from the Russians around Kharkiv, and that is not what the Russians would wish. I also noticed that the US supplied howitzers are now coming into range of Russian positions, and the Ukrainian artillery has started to bombard Russian positions from a safe range, because these howitzers have a longer range than the Russian artillery has. And Russia has captured Mariupol, and they've captured their main invasion goal, which was the functional steelworks at Azovstal, and it's going back into production next week, I think, Keith. Ukraine has gained a little bit of ground in the south. I mean, the Russians are still continuing to suffer this enormous rate of attrition, and their armor is continued to be taken apart by these modern anti-armor weapons. And so, going around, we have maybe 30% of the invasion forces being degraded. They suffered huge damage, and it was notable that Putin has backed off from saying that the northern European countries who wish to join NATO will suffer immediate military threats, to saying they can do what they like, but he's not happy about it. Basically, he has no military left to attack anybody unless he resorts to nuclear missiles. And the Russians they're still trying to get that eastern strip of land that gives them access to the Black Sea and the Sea of Azov, and a land corridor from Russia to Crimea, and to isolate Ukraine from its Black Sea ports and its ability to export its commodity production. And I think that the attrition rate, I think the Russians will withdraw at some point without holding this land in the next 6 months. Whether that's because Putin is deposed or they simply can't afford to take the losses anymore, I don't know. So, Ukraine is making limited progress in recapturing. It is becoming a war of attrition. Russia has now just decided to try and get that strip of land. It is grinding on, and unless Putin is deposed and whoever takes his place has a different attitude, there's no obvious exit from where we are now.
I agree.
Depressingly.
Yeah, so expect a long war and continued sanctions, continued disruption to the world economy. Okay, on to recession watch. Now, I thought this was an interesting chart. So what it shows is the blue line is PPI, so it's input costs, and the orange lines is PMIs, which are output. And what you're seeing is very high input costs and falling output. And the last time you saw that was just before the great financial crisis. Not a good combination, very bad for corporate profits.
And the other problem we have with all of this is you run into the issue of debt serviceability if the economy starts to stagnate, and at very high levels of debt, increasing interest rates, government debt serviceability starts to get thrown into question.
Yes, and there's evidence of that in junk bond spreads, junk bond yields, which are rising quickly and again are a sign of financial stress. And this, we've shown you this earlier, but so this is University of Michigan Consumer Sentiment Index. And you'll see when it's this low, we're normally in a recession, frankly. So it could well be a harbinger of recession.
Or a minor improvement to the inflation rate, Keith, would do the job.
Yes. And this is buying conditions for houses, which are incredibly poor. So this chart is 15 years, and this is by far the worst conditions in the last 15 years. That includes the period of the great financial crisis.
That's an amazing chart, Keith. It shows that basically the buying conditions have dropped off a cliff over the last 12 months or so.
Yeah, you had a combination of rising interest rates, rising mortgage rates, and very high house prices. And there are good reasons to believe that the housing cycle is the economic cycle. And as people stop buying new homes and house builders then cut back on construction, that will slow the economy. Now, but one piece of good news, the SARM rule is not showing any danger of recession at all. And the SARM rule looks at the change in unemployment. And obviously labor markets are tight. And essentially there is no change, as yet, there's no uptick in unemployment. But if you look at this chart carefully, you'll see the SARM rule tends to kick in once once a recession has actually begun.
It's a slightly lagging indicator, isn't it, Keith?
Yeah, absolutely. But anyway, employment, the labour market still looks very good. So in summary, leading indicators are turning down. Reminder, we are expecting a recession in the UK and the EU before year end, and in the US thereafter. And in the UK, the labour market, in the UK and the US, the labour market continues to be very strong, which should mean that the Fed and the Bank of England will have to keep on raising rates. But the labour markets are showing no sign of recession as yet, but they tend to be lagging indicators. Okay, Richard, China.
So looking at China, the issues China have been facing of late is the lockdowns that have been imposed to try and stop COVID from spreading, the supply chain problems that's caused the world, not just in China, the issue relating to the Chinese property market and the fact that it's in a bubble and we have a number of Chinese property companies who appear to be going bankrupt, and of course the importance of China to the world economy. So we have almost universally bad economic news coming out of China. So everything was amiss except the. So looking at the latest economic news coming out of China, it's pretty much universally bad, with everything being amiss except China fixed asset investment year on year, which is up 6.8% in April and 9.3% in March, actually. And China import growth, which was not as bad as expected. So the Chinese economy is slowing down pretty quickly. We know that the information that data comes out of China isn't reliable, and the consequences of the lockdowns must, particularly in Shanghai, which is one of the most economically productive regions of China. And actually, I read the other day that viewed as it's on its own, that region with 100 million population would be the fourth largest exporter in the world. So it's hugely important to the Chinese economy. The Chinese economy is staggering, and presumably the fixed asset investment is the government investing, spending money to try and get the economy back on its feet. The lockdown is clearly disastrous economic policy, and it's probably due to the fact that Xi is incapable, for political reasons, of changing the strategy that has been adopted over the last 2 years for managing COVID, which is a sort of zero COVID policy. And they have caused huge damage to their economy. I don't know. How do you think this is going to pan out, Keith?
Well, there's a problem with dictatorship. He has set his heart on this zero COVID policy, and now he's going to lose face if he changes it. So the danger is that the virus will come back. We know that the Omicron has an incredibly high R rate, and the chance of the manager to keep it out of the cities is, I think, really low. Now, what they can do is just try and suppress the news for as long as possible to try and stop another lockdown. But to me, it's inevitable. If they continue with this policy, at some stage, they're going to have to lock down again.
I couldn't agree more. And it's very difficult to know how they ever get out of this without vaccinating the population with a vaccine that works. So there we have China industrial production year on year, which is down 7% from where it was a month ago.
Yeah.
Retail sales down 17% from where it was a couple of months ago. Fixed asset investment, and a longer term chart of Chinese fixed asset investment. China outstanding loan growth, which is declining quite rapidly, and suggests the economy is, it's still fairly significant growth of 11%, but it's slowing down. And Chinese exports year on year have fallen off dramatically in the last month. China imports year on year, likewise. Of course, industrial activity has effectively ground to a halt. And the manufacturing PMIs look remarkably healthy under the circumstances, Keith.
Although they are negative, 50 is neutral.
Yeah.
So.
Yeah, but they still look remarkably healthy given they shut their economy down.
Yeah.
Or a chunk of it. Services PMI is actually looking very, very sick.
Mm.
And the composite PMI is looking pretty sick, really dragged down very hard by services. The youth unemployment rate is moving up, and that must be quite a concern to the Chinese Communist Party, because youth unemployment is very socially problematic. So the Chinese economy basically is under the cosh from the COVID restrictions. Opening up Shanghai a little bit, it's hard to know how this policy has any coherence to it. And they're going to act to support the economy, but they're really in a very difficult place because the economy is over leveraged, and the economy is hugely dependent upon imports, as well as being a major exporting country. So it's quite difficult to know if they could persist with this lockdown strategy. It's difficult to know how they don't destroy the economy.
No, I agree. And also, they're going to try the same tricks again that they've used before, fixed asset investment. But the Chinese economy has been hugely dependent on housing. And you know that Chinese house prices are just absolutely ridiculously high compared to incomes. And we're seeing a lot of Chinese property developers start to fail. And you really wonder whether the Chinese property cycle has finally peaked and whether they're going to be able to use the same housing market stimulus measures that they've used before.
And of course, if they pump too much money into the economy, they'll stimulate inflation.
Yeah, but honestly, I think that's the least of their worries, Richard.
Yeah.
Okay, thank you, Richard. Now, short piece. Now, what I do is I largely play the oil cycle because I think it is quite predictable and very violent. So there are big swings between peak and trough. And if you can time those swings, then you can hopefully make decent money. So another way of looking at that is to look at the capital cycle. So if you think about the oil cycle, what happens when prices are high is that oil companies are making a lot of money and they start to invest in lots of new projects. And you know, in a few years' time, that those projects will then start to yield big increases in oil production, and that will tend to depress the oil price. And the opposite is true. When the oil price is low, everyone cuts capex, and a few years down the line, there's not going to be much oil coming through the pipeline, and oil prices will rise again. So I look at the capital cycle, and this chart shows that it works not just for oil and commodities, but also for tech. So if you look at this chart shows capex. The orange line is capex in the technology sector. The blue line is capex in, so have I got that right? Sorry. The blue line is capex in the commodity sector. And this is a long-term chart, 30 years between 1981 and 2021. And you'll see that when capex is high for the commodity sector, as it was in between 2009 2015, subsequently returns for commodity stocks were really poor. They were minus 34% over that period between 2009 and 2021. Whereas the capex investment in tech was then at a cyclical low. And if you bought tech then, you would have had a return of 582%. Now, right now, we have very high capex in tech, very low capex in commodities. And so you would expect going forward strong returns for commodity stocks, and we've had very strong returns over the past year, and very weak returns for technology. Everyone has invested in technology over the past few years, and going forward, there'll be a glut of technology, essentially. So, in conclusion, watch the capital cycle. It is a really good way of determining your asset allocation. And so right now, capex in commodity stocks is really low. And what is very noticeable is that it hasn't really picked up despite very high commodity prices. So that all means that going forward, when we come out of this recession, commodity supply is likely to remain towards historic lows, and we are likely to have another strong rise in commodity prices. In contrast, the last 5 years has seen extraordinarily high investment into tech, and returns to tech are likely to be poor.
Moving on to our next little section, is it time to buy the Nasdaq? Is the question. So this is a chart of the Nasdaq, which had a fantastic run over the last 13 years. And as of last week, it was on a PE ratio of 26 and a dividend yield of 0.84. And you can see that, if you just go back, Keith, you can see that really the Nasdaq has gone nowhere. It's gone up and down, but it is still at a level it was in beginning of the end of 2020, beginning of 2021, so 16 months. So, and this year has been poor because we've seen that the drop from that point down to where we are today. The Nasdaq 100 is the collection of the largest cap tech stocks. And as we all know, fair value can be undershot and overshot all the time. It isn't something that the markets level out at. They oscillate around it. The table below shows the PE at the chart date, i.e. the current level, which is 27, and the price sales is 5.3, and the EV to EBITDA of 18.8. And the fair ratio is the 2014-15 numbers, where it had a PE of 19, price sales 2.9, and EV EBITDA of 11. And if you take the where the implied index level is using the fair ratio, on the basis of PE, it's 10,160, which is a 15% drop from today's figure of 11,900. On price sales ratio, you get a 33% drop to 7,900. And on an EV to EBITDA ratio, you get a 49% drop from the current price level to an implied index level of around about 6,100. So the conclusion of this is that we are nowhere near the fair value for the Nasdaq. It has another 50 to 50% to drop, assuming it doesn't overshoot to the downside to fair values. And given that it's already dropped, 30% from its peak, very roughly, we are looking at a 50% from the 30%, which I can't do the maths in my head, but is a very chunky drop indeed. If it were to drop down to 6,000, it would be a 70% drop.
Yeah. What I find interesting about this table, and thank you very much to Stuart Owen, who is on holiday in Japan at the moment and emailed this in. What I find really interesting about this table is that if you look at enterprise value over EBITDA, then you get a much bigger fall. And that's because they've all loaded up on debt. So, enterprise value is higher because they've got loads of debt compared to equity. And also EBITDA, they've actually, that is before interest, but they will also have continuing interest payments, which will depress earnings going forward if there's a downturn. So not a good combination.
No. I think in conclusion, don't buy the Nasdaq just yet.
Thank you, Richard. Moving on to LNG. Now, two of our Discord members, Richard Wilk and Simon W., sent me this deep dive into future LNG production. And we know that Europe is trying to wean itself off Russian gas. And a big part of its plans to replace Russian gas will involve importing a lot of LNG. And this shows the intended increases in LNG liquefaction capacity in the years to 2026. And you'll see that a lot of the growth comes from North America, from the US, and that is the dark blue bar at the top. And so these are the number of projects planned in each of the regions. So the light blue bar is existing capacity. The green bar is capacity where they have made the investment decision, and the dark blue bar is planned. And you can see in the US, they've got huge plans, which they have not yet pulled the trigger on. And if all those plans come to fruition, there will be around a 40% increase in global LNG production capacity over the next 3 years. So huge increases, mainly in the US. And so this is the pie chart of current world LNG production, and you see it's dominated by Australia first, then Qatar, and third is the US. But if the US plans to increase their production come true, then the US will overtake everyone else by a huge margin. So the US will then be 7 times larger than number 2, and Australia will remain number 2. So the US will dominate the world industry. And that means that the gap between US and UK natural gas prices, or European natural gas prices, will start to close. And currently, you see that UK natural gas prices are much higher than American ones. And if the US massively increases its LNG exports, then that gap will start to close, which should be bearish for European natural gas prices and very bullish for US ones. Now, there is a political element here. Will US government allow US gas prices to rise? And they will be concerned by the impact on US consumers of very low historic US gas prices rising towards European levels. And so at some stage, there may well be political pushback on building more LNG plants because of the impact on US consumers. And on a related subject, UK gas prices. So UK gas prices have diverged very strongly from Europe, and that is odd. Historically, they move entirely in lockstep, and then suddenly, over the course of the last 6 weeks, they've diverged very strongly, and UK gas prices have fallen compared to Europe, and that's really good news for UK consumers. So what's going on? Well, what's going on is the UK has 3 very large LNG import terminals, but only 2 interconnectors with Europe. So if we look at the map of LNG terminals in Europe, UK has 3 big ones, but Germany has none. So the UK has a lot of import capacity compared to its size, compared to Europe. And then we are exporting as much as we can to Europe, but our imports are currently larger than our capacity to export it or to use it ourselves. And there was a report in the FT yesterday that National Grid are now stopping further LNG imports into the UK because they're concerned that there's too much and any more, and the gas pressure in the system will rise too high, causing problems. And reminder, the UK has limited storage capacity, and we could be storing this gas glut, but we've closed the rough storage capacity offshore Northumbria, which makes us more exposed to the spot market. So these are flows of gas from the UK to Europe, and you'll see we're running at pretty much maximum capacity at the moment. But the bad news is that if you look at year ahead gas prices, well, they move back into lockstep, I'm afraid. In fact, so the UK, which is the red line, expecting them to be higher than European prices in the winter of next year, strangely. So in summary, we currently have a gas glut, which is something we wouldn't have expected. And when we talk about the energy crisis on this podcast, we were certainly not expecting that a couple of months ago. But we don't have very limited gas storage capacity, which is a failure of government, essentially, and of energy planning. And that means that we can't store this current gas glut. And by next winter, it will have passed and we'll be in shortage again. And we're expecting high energy prices next winter, sadly. Okay, on to other charts, Richard.
So, crude oil by the S&P on a log scale. It suggests that when you have rising oil prices, you have a decline in the S&P, and the crude is on the sort of dark line at the top, and you can see right now we have very steeply rising oil prices, and the S&P has started to decline. This chart is slightly out of date, I think, but clearly it's because of the tightening of the financial conditions and the deleterious effects of rising crude prices on the economy. So a lot of pressures on the S&P, as we know, including crude.
Yeah, and actually the fact that this chart is out of date, I think adds to its explanatory power, Richard, because the crude price since this chart was made has shot up and the S&P has fallen quite sharply.
So the US fiscal deficit has also fallen sharply. And I don't particularly know why this is. Do you know why this is, Keith?
Yes, because Biden has failed to get his infrastructure spending bill through. And also, the US actually has had massive tax receipts as everyone has gone to work.
Okay. So that puts them in a less unhealthy position than they were in peak COVID, and actually a less unhealthy position than they were in 2008. I mean, they still have a fiscal deficit, but it is looking a bit better than it was.
Yes, well, it's better than it was. It's still enormous. But also, I did a piece on accounting identities a while back, which I've split out as a separate podcast, and I'd urge people to watch. And a reminder that falling fiscal deficits equals falling corporate profits from a national accounting perspective. So you'd expect that now the government is running a smaller deficit, that corporate profits will start to fall. And that is also what we've seen.
US production employment has previously been a good recession indicator. So, I mean, it's sort of, there's a coincidence between the grey lines and a reduction in construction employment, but I'm not sure that it's necessarily a great indicator. Looking at some of these coincidences. So, anyway, there's no sign of it falling yet, I think we can say.
Well, this is the updated chart, Richard, and actually I'm going to disagree with you on that. I think that the construction sector is a really good harbinger of future recessions, but it hasn't really started to turn down yet, but it's something to watch.
Mm-hmm.
Okay, on to equity markets. Richard.
Yeah, so it felt like everything has been bouncing around massively, but actually the net effect has been very small. So FTSE All Share virtually unchanged, Stocks Europe 600 virtually unchanged, S&P only down 0.7%, the Nasdaq virtually unchanged, Hang Seng up 1.1, Topics virtually unchanged, Bitcoin very slightly down, GBP up by half of that horrendous run that it's had, up 2%, and dollar index down 1.6%, which is fairly chunky fall. But of course, if you look at the year-to-date changes, they are very substantially larger. The one I find interesting is the FTSE, which has been remarkably resilient. As we know, it's heavily commodity weighted, and it's been remarkably resilient in the face of the big declines in the other world markets.
Yeah, there's a low tech weighting in the UK.
So I think we've covered this previously. The S&P, as we know, has had a terrible start to this year, but terrible starts to years often result in a good performance going forwards. So the question is the S&P going to have a good 7 or 8 months from now on? And history suggests it may well be the case. And this is a chart that shows equity returns during past recessions. So the biggest drop actually was the 2007-9 recession, which was about 55%. But on average, they drop about 27.5% in recessions. Note that we're not actually in a recession at the moment, according to the official data. So if we enter a recession now, you would expect the average drop to be 27% from now, which would take it down to, well, whatever it takes it down to. So be careful, I think, is the message.
Yeah.
And the monetary tide is turning. So the Bank of America Global Government Index for Global Index of Government Bonds is dropping sharply, and that's the price index. So, and the MSCI World Index basically follows reasonably closely. It has done for the last 10 years. This the government yield index, and that is suggesting a 30% drop in global equity markets in response to the decline in government bond prices. And the Buffett indicator, which is an indicator of how overvalued or undervalued the market might be, suggests that markets have 30% or so to fall from this point, which actually is coincident with the average fall during a recession and the size of fall we might expect from the looking at world bond markets, government bond markets. So things are lining up to suggest we've got significant fall to go.
Yeah, the Buffett indicator, Richard, is total value of the equity market divided by GDP. Okay, thank you, Richard. On to commodities. And we were talking earlier about the CapEx cycle. And what is really remarkable this cycle is how little CapEx there's been. So after many years of very poor performance by commodity producers, now that they're making lots of money, they're not spending it on new projects, possibly because of the uncertainty around the regulatory environment and also the energy transition. If you believe that oil and gas are going to be much less of the energy mix in 10 years, and everyone's saying oil prices will be lower, will you commit to a big CapEx project, which is going to take 10 years to come to fruition and cost you billions of dollars? Probably not. You're going to think long and hard about doing so. So instead, commodity producers have prioritized buybacks and dividends over capex, and that actually bodes well for future commodity prices, but not necessarily well for the world economy, because when we come out of the next recession, commodity production will be constrained by a lack of current capex. Okay, on to energy commodities. And despite the volatility in equity markets, oil had a good week. So Brent was up 2.6%. WTI was up 4.6%. And actually, as of this morning, was above Brent. So having been at a discount to Brent for years, it suddenly moved to a premium. In Europe, the TTF natural gas future fell sharply, so down 14% on the week. And we're now moving into the summer months where we use less gas, and we are getting lots of LNG supplies from the US. Coal continued to shoot higher, up 5% this week, up 143% year to date. Astonishing. And uranium drifted off, down 3.6% on the week, but still up 12% year to date. Okay, on to some data relevant for the oil market. So in the US, total crude inventories fell by 8 million barrels. Now, last week, we were concerned about a rise in crude inventories, but actually this week they fell quite sharply. And excluding the SPR, private stocks fell by 2.9 million barrels on the week. So despite big releases from the Strategic Petroleum Reserve, US private inventories fell by 2.9 million barrels, and that's very bullish for the oil price, and hence WTI shot up. US crude production was 11.9 million barrels, up 100,000 barrels a day compared to last week, but only up 100,000 barrels year to date, and that is massively below expectations. And the Baker Hughes rig count was up 6. Okay, so this is crude. Still the upward trend intact. And this is global air traffic, which is up on 2019. So demand for jet fuel will be rising, adding to oil demand. But Chinese oil refiners used 11% less crude in April due to lockdowns. So as those lockdowns now start to ease and the Chinese start getting back to work, that will reverse, adding to oil demand, bullish for oil. This is the EIA's forecast for Russian oil production. You'll see, prior to the Russian invasion of Ukraine, they're expecting growing Russian oil production, and now they're expecting it to fall sharply by over 2 million barrels a day by 2024. And the indications are that it has fallen sharply over the course of the last month. So it produced 1.3 million barrels below its OPEC target in April. And as a result, OPEC plus exports, which were meant to be growing this year, reminder, they're aiming to increase production by 400,000 barrels each month. So this month, they should have been producing around 2 million barrels more than they were producing in December last year. And actually, they're producing less. Global crude inventories have actually been rising this year, as estimated by Kairos, which uses its own inspections of onshore oil inventories, not official data. But most of that build in inventories has occurred in China rather than the rest of the world. But even in the rest of the world, the decline appears to have stopped. So that slightly contradicts the picture we're getting in the US from US inventories. These are Dutch natural gas futures, which seem to be drifting off, which is good news for the European economy. Coal just continues to shoot up. Uranium drifting off its peaks. Industrial commodities, Richard.
So aluminium, a big jump this week, nearly 5%. Cobalt fell 8%. Copper is up 3%, so quite a volatile week in commodities. No change in chromium, iron or lithium. Neodymium up 1.7%. Nickel down 6%. Still up 25% year to date. And tin is now starting, I think, a vigorous decline. 7%, nearly 8% down on the week, 15% on the year. Ferrovanadium, no change on the week, 24% on the year, and zinc up nearly 5%. Just a reminder, why do we have ferrovanadium in here? Mostly because of its potential utility as a battery metal for large-scale storage, also because of its usage for strengthening steel in small quantities. So there we have the price of aluminium.
So I think some of the aluminium and copper bounced with hopes for Chinese demand as China reopens.
Yeah. Cobalt, copper, chromium, iron ore, lithium, neodymium, and nickel, very strange looking chart. And tin, a huge spike up, followed by what looks to be a symmetrical drop down. And ferrovanadium. And finally, zinc. So moving on to precious metals. A slightly better week this week for the precious metals than in the last few weeks. Gold up nearly 1%, silver up 5%, platinum 0.3%, rhodium 3%, and palladium 2.2%. So all of them up year to date, with the exception of silver, and obviously gold is almost unchanged year to date. So there we have gold. And the price of gold in GBP, which is not far off its all-time high.
Yes, we report in that table everything in US dollars. And of course, the US dollar has risen very strongly this year, which tends to give a depressing picture of precious metal prices. But of course, if you price them in, for example, sterling or euros, they've done much better. And actually, in sterling terms, gold price is pretty much near its all-time highs and has retained its value.
Yeah. Silver, which has done badly. Yeah, platinum, rhodium, and palladium.
Okay, thank you, Richard. On to rates. Well, despite the volatility in the equity markets, there was no safe haven buying in the UK this week as inflation came in hot. And so we had rises in yields across the curve. So the UK 2-year now yields 1.5%, and that's up 25 basis points on the week. And the 30-year now yields 2.09%, and that's up the best part of 10 basis points on the week. In the Eurozone periphery, yields continue to rise. So the Greek 10-year now yields 3.56%, up 20 basis points on the week, and the Italian 10-year yields 2.9%, up 17 basis points on the week. So something to watch. When Italy has to refinance its existing bonds, if it has to start refinancing them at market rates, it will be in trouble.
I think the other thing you just have to remember that table, Keith, is that the relative increase from on the year. So Greece started off at 1.28% and now 3.5%. So that's not far off a tripling the interest rate.
Yeah, absolutely. Now, we did a separate podcast a while ago on Greek debt sustainability, and the Greeks are not really exposed to market prices because most of their debt is held by European institutions. It's Italy is the big worry. They're too big to save, basically. And as you point out, the Italian bond yield started the year at 1.18% and it's now 2.9%. That's a big rise in percentage terms, and they have to refinance their debts at these levels. They're in trouble. Now, this is market expectations for Fed rates, and they're stabilizing, implying a future Fed funds rate will peak at 3%. I'm very skeptical. I know Richard is as well. I don't think they'll get anywhere near these levels. And this is liquidity in the bond markets, which is absolutely terrible. And I think the same is true of equity markets. And we'll discuss that further when I talk about my own personal portfolio. But bond market inflation expectations appear to have peaked. So this is the Italian 10-year bond yield, and the upward slope appears to be intact. Greece, again, trending upwards. This is the UK 10-year. Is that a peak, a topping formation, we ask ourselves? This is the UK 2071 gilt, and is that bottoming? So have yields, very long-term yields in the UK, have they peaked? This is the US 10-year. Again, we've got a pause. Okay, so concluding comments, going through what we have learned this week. So equity markets can't seem to sustain a rally. Corporate profit margins are under pressure, and this is something we've covered over many weeks, but very high input price pressure and declining consumer discretionary spending are not a good combination. And we expect corporate profit margins to be squeezed, and that's bad for equities. Oil prices have resumed their rise, and US inventories are continuing to draw down. So that is bullish for oil prices going forward. Wheat prices are rising, food prices are rising. Next week, we should get the latest UN Food and Agriculture Organization food index numbers, and we'll report those. So bottom line, equities appear to be in a bear market and getting bounces, but those bounces are actually quite short and can't be sustained. So bond markets appear to have, the yields appear to have ceased rising for a period. So are we seeing a bottom in bond prices, but very volatile. Cash is the safest asset at the moment, in my opinion. Richard, any thoughts?
Yeah, I think a good summary, Keith. I think the conundrum remains there. It's very difficult to predict where a safe place is to put your money. I know you're starting increasingly to wonder whether bonds may be becoming a safe haven. Clearly, it depends what central banks do with interest rates over the next couple of months, and what happens to inflation rates. But very unstable global situation generally as well. Very difficult time to invest in.
Yeah. And on that note, Richard, what have you been up to this week?
Thank you, Keith. So my 1 week change was up 2.9%, putting me back to 7.2% for the year, and the relative performance of the FTSE all share of 11.2% up. So a better week for me this week than last week, mostly as a result of the fact that the price of gold stopped falling and had actually risen a little bit this week, and that has reflected quite nicely in my precious metal shares. Actually, the same is true of silver, and I think a little bit of a boost for my oil market shares, which are nothing like the proportion that Keith has in his portfolio, but nevertheless nice to have. So no purchases and no sales, so I'm continuing my policy sitting on my hands, and so not a lot to report on the portfolio particularly, but I just thought this was an interesting chart. This is gold versus the S&P over the last 20 years and 22 years, and gold is the sort of orangey line at the top, S&P is yellow, and the S&P total return is with dividends reinvested. It's quite an interesting chart. Most of the outperformance obviously came in the period of 2006 to 2012, and if you're bullish on gold, then you'd say it's lining up nicely for another period of outperformance. Of course, it may outperform by the S&P dropping in it and the price of gold remaining constant. So we don't know. Last week I reported that I bought some agricultural commodities, and this is just an update. Wisdom Tree Agriculture Weekly, and a chartist such as Keith, who we realised last week was our charting guru, can tell you that is probably a fairly bullish formation, and a breakout above the top of the triangle would be a bullish sign. So we're watching with bated breath. And then this is the Bloomberg Commodity Index, which is all commodities. And again, I think the point to note here is that while we've had these significant drawdowns in the S&P and the Nasdaq, commodities haven't. They've been volatile, but they haven't drawn down in the same way, which suggests that they are marching to a different tune to the stock markets. And that's it, Keith. Short and sweet.
Actually, before we move on, Richard, when you're saying that you've got no buys and no sales, I mean, what is your so question? What's your allocation at the moment, asset allocation, and what are you intending to move to?
So my asset allocation is basically entirely commodities.
Mm-hmm.
And I think the commodity bull market is by no means over. So I have a significant holding of precious metals, some oil, and then shares in other commodity miners such as copper, nickel, and ferrovanadium. And I don't think the commodity market is anywhere near over. And looking at this chart here, there's no reason to sell. And I don't think that the commodities, this is a fingers crossed moment, but the commodities that I favour are those that are involved in the move to the electrification of the world, which are all going to be in short supply if government plans are in any way achieved. So I think there's going to be tremendous demand over the next 10 years. And I think we're going through a bit of a tough patch at the moment. There was, if you look at this chart here, there was this really big rise in run up in early 2022. I think we're suffering a reaction to that now, but it's interesting that it hasn't fallen back down to maybe retraced half of its gain or more even. And so I think there's a lot of sustaining pressure there for these commodities. Now, if there were a deal with Russia tomorrow and Russia withdrew from Ukraine, all sanctions fell off, then I think that would make my strategy tricky, shall we say. And I think that's the biggest risk to it at the moment. Would you like to tell us about your week, Keith?
Thank you, Richard. Okay, I had a good week, not as good as Richard, but up 2% on the week, and that takes me to up 21% on the year, so having a very good year. Okay, now, unlike Richard, I am selling down, and I believe that the world economy is going to go into recession, and that will hit demand for all commodities. And I'm expecting a broad sell-off in both commodities and equities, and I am moving increasingly to cash. Now, I sold pretty much every stock in the portfolio this week. So in this table are just ones that I got completely out of. So I sold both winners and losers. I sold everything. Now, of those companies, the only one I really want to talk to about is Pharos Energy. And Pharos Energy have assets in Egypt and Vietnam. And one of the things I've learned over the course of this cycle is that essentially explorers and oil companies in Egypt have performed very badly because they only get around 20% of the revenues from their oil production. The rest go to the government. And you would expect high oil prices to have raised the price of these Egyptian producers because they are still getting 20% of the increase in the oil price. But sadly, that hasn't happened. They've been really poor performers. So Capricorn Energy, Pharos, SDX, they've all been actually just really poor. And next oil cycle, I will be avoiding Egypt altogether. No buys. Now, when I say I'm selling down everything, there are a few stocks I intend to keep throughout the cycle, and they're ones with big idiosyncratic risk, so where there are particular developments. So Entech Upstream I hold in, and that has is developing this new directional drilling bit, which should be coming into the market later this year. Very small company, and if they have any sort of market traction, that will be transformative. Petrometad, development oil assets in Mongolia, an unending stream of misfortune, essentially, and the Chinese lockdown as the latest piece of bad news. But now those lockdowns are ending. They may be able to get their Heron 1 field into production finally, which would be transformative. But that's been an ongoing saga of disappointment that hopefully will now be coming to an end. And Goldplat, I just think, is extraordinarily undervalued. Now, it's a gold recovery specialist we've covered many times on the weekly, and it's growing revenues, P ratio of less than 3. I'm mystified why the shares aren't moving. Okay, so this is my asset allocation. That was at the start of the week. I had 62% equities. As of this morning, it's down to 41%, 59% cash. And I'll be moving over the course of the following weeks to almost entirely cash. And my next move will be to start buying bonds as I think the interest rate cycle peaks and as the economy moves into recession.
Oh, thank you very much.
Sorry. And this is my equity allocation again at the start of the week, almost entirely and irresponsibly in oil. There's some in the miners, but I've mainly sold those down now, and a little bit in gold, which is all gold plat, and I intend to retain. So the only other thing I wanted to talk about was bear market rallies. So this is the bear market 2000 to 2003 in the Nasdaq. Actually, this is the S&P 500, and you'll see over that time there was an extraordinary fall. So the S&P fell from 1500 to 800, but during that fall there were big rises. So if you're interested, pause and take a look. But there were 3 bear market rallies, one of 19%, one of 21.2%, one of 20.6%, one of 20.9% within that huge fall. And if we look at the big bear market in the great financial crisis, again, you got these really strong bear market rallies, one of 19%, one of 25% before the final low. So what I found interesting about the current bear market, in the Nasdaq in particular, is how few bear market rallies there have been. And normally you'd expect to find some strong and sustained ones, but recently all the bear market rallies have been faded very quickly, and to me that implies that we've got a lot further to fall. And I have been taking advantage of the few up days to offload positions, and my experience from selling down the portfolio, and I'm now sold out of most of my smaller oil positions, is that liquidity is at a premium. So in some of the small oil companies I bought in fairly decent size fairly easily a few months ago, but now selling them, I've had to cut them up into very small chunks. And in a couple of positions, I was having noticeable impact despite selling $2,000. So be aware that as the bear market develops, liquidity in some of these small oil companies, in some of the small companies, just completely disappears. And you should be aiming to get out of your less liquid positions in the bear market rallies. Okay, that's it. Thank you all for watching. It's been so next week we'll be back to normal. This week Richard was on his boat and I'm dialing in from Cumbria. But thank you for watching. Please can you press like and subscribe to the channel. And it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.